Federal Reserve officials made history recently by hiking rates by 3/4 of a percentage point for the second straight month, delivering the most aggressive tightening in more than a generation to curb surging inflation, but risking a sharp blow to the economy. Today we will tell you about housing market, current mortgage rates and the Fed rate hike. 4. What the Fed's rate hike means for the housing market. The housing market is complex. Prices are driven by a wide variety of factors that are local, regional, national, and global. While basic concepts like supply and demand come into play, other things like mortgage rates, inflation, and even economic conditions in other countries all influence the housing market. Policymakers, facing the hottest price pressures in 40 years, lifted the target range for the federal funds rate to 2.25% to 2.5%. That takes the cumulative June-July increase to 150 basis points, the steepest rise since the price-fighting era of Paul Volcker in the early 1980s. Federal Reserve Chairman Jerome Powell said the path to avoid a recession may have narrowed, but he doesn't believe the nation is currently in the throes of one. That being said, Lawrence Young, chief economist for the National Association of Realtors, believes raising short-term Fed funds rate by 75 basis points is unlikely to do any further damage to mortgage rates. The effects of higher rates are particularly evident in the housing market, where sales have slowed, but Young sees a light at the end of the tunnel. If mortgage rates do stabilize near the current rates, home sales will be dependent on jobs and consumer confidence, he said. Job creations have been ongoing to date. Therefore, home sales could soon stabilize within a few months and then steadily turn upwards from early next year. Noting that Russia's war against Ukraine is causing tremendous human and economic hardship, Fed officials said the war and related events are creating additional upward pressure on inflation and are weighing on global economic activity. The committee is highly attentive to inflation risks. The Fed seeks to achieve maximum employment and inflation at the rate of 2% over the longer run and anticipates that ongoing increases in the target range will be appropriate. 3. Inflation and housing. Inflation is the process through which money loses purchasing power. For example, inflation in the past year was 8.5%, so something that cost $100 a year ago would cost $108.50 now. Inflation impacts the housing market in a few ways. For one, inflation causes the prices of homes to rise just as it causes the price of all goods to increase. However, one of the Fed's goals is to try to control inflation and keep it at a steady, low rate. If inflation rises significantly, the Fed might increase the federal funds rate to reduce the money supply and reduce the inflation rate. This increase in the federal funds rate can cause mortgage rates to rise, and rising mortgage rates can decrease home buying demand, leading to a fall in home prices. 2. Current interest rates. Current mortgage interest rates, which are impacted by the federal funds rate and other market rates, influence the price of housing. When rates rise, that leads to an increase in the monthly payment for a loan of the same amount. For example, at a 4% interest rate, a $250,000 mortgage would cost $1,194 per month. At 6% interest, the same loan would cost $1,439. The effects are even greater for larger loans. According to Allison Waddell, an agent success manager at Realty Hop, a nationwide housing website, recent increases in rates have had a big impact on purchasing power. With mortgage interest rates around 6%, American homebuyers have 24% less spending power than they did a year ago. As rates rise, people can't afford more expensive homes, which can kill demand and drive down prices. 1. Given current conditions, what's next? Predicting the future of the real estate market is difficult even for the experts. No one really knows how things are going to change in the future. On the one hand, interest rates have risen significantly in recent months, and the Fed has not done anything to make it seem like it plans to slow down. However, housing prices have spiked in the past few years, increasing by more than 30% since 2020. Some believe that rising rates and an economic slowdown will force prices to fall. Others insist that inflation and reduced housing supply caused by a slowdown in new construction and institutional investors buying inventory will lead to prices holding steady or continuing to rise. Do let us know in the comments what are your thoughts about this matter. Thanks for watching.